All right, let's jump right in. At the absolute heart of investing, there's this huge challenge that every single one of us faces. How do you get the best possible return on your money without taking on a terrifying amount of risk? Well, today, we're going on a quest to find the right price for risk. And our guides will be some of the most powerful, Nobel Prize-winning ideas in all of modern finance.
I mean, this is the classic investor's dilemma, isn't it? You see that potential for your investments to shoot for the moon, but then there's that nagging fear in the back of your mind, the thought of a market crash wiping out your hard-earned savings. So, how do we crack this thing? How do we solve this puzzle? And this, right here, lays out that internal battle perfectly. On one hand, of course we like higher returns. That's the whole point, right? But on the other hand, we hate risk. We dislike that wild volatility, those gut-wrenching swings that can give you financial whiplash. We want all of the upside with none of the downside. And that tension, that's where our whole quest begins. So where do we even start? Well, the first big clue comes from a piece of wisdom you've probably heard a million times. Don't put all your eggs in one basket. In finance, we call this diversification, and honestly, it's kind of like magic. But to really get how it works, there's one key idea we've got to wrap our heads around first. And that idea is called correlation. Now, don't let the technical term scare you. It's really just a fancy way of asking a simple question. When you look at two different investments, how do they move? Do they rise and fall together, or does one zig when the other one zags?
This shows the whole spectrum perfectly. Over on one side, you've got a correlation of +1. That means two stocks move in perfect lockstep. When one goes up, the other goes up by the same amount. On the other extreme, you have -1, where they move in perfect opposition. But see, the real magic, the secret sauce of diversification, happens everywhere in between those two extremes. Because if one of your investments is having a really bad day, another one might be having a great day, and that smooths out the entire ride for your portfolio.
Okay, so we get it. Combining assets that don't move in lockstep can lower our risk. But how do we use that to find the absolute best combinations out of the thousands of possibilities? It's one thing to know it works, but how do we turn that into a real strategy? For that, well, we're going to need a map. And the person who drew that map for us is this guy, Harry Markowitz. All the way back in 1952, he laid the groundwork for what we now call modern portfolio theory. And this wasn't just some small idea. We're talking about a concept so revolutionary it snagged him a Nobel Prize. He basically proved, with math, that diversification isn't just a folksy saying, it is the single most optimal strategy.
So let's see how his idea builds out. On this graph, we've got expected return going up the side and risk or volatility along the bottom. Now, if we just take two stocks, A and B, we can mix them together to create a whole range of different portfolios. And look at this. See how the shape of that curve changes depending on their correlation? The lower the correlation, the more that curve bends over to the left, which means you get less risk for the same return. And that is exactly what we want.
And this right here, this leads us to the map itself, the efficient frontier. This line, it's like the holy grail for portfolio builders. It represents every single best possible portfolio you can create. Think about it. For any level of risk you're willing to take along the bottom, there's a point on this line that gives you the absolute highest return possible. You'd never choose a portfolio below the line, because why would you? You could get a better return for the exact same risk right up on the line.
But looking at this map reveals a really crucial fork in the road. And this is huge. It turns out that not all risk is the same. There are actually two fundamentally different types of risk, and understanding the difference is the key to unlocking the rest of our quest.
Okay, so on one side we have firm-specific risk. Think of this as the kind of bad luck that can hit just one company. A bad earnings report, a CEO scandal, you name it. But here's the good news. You can basically wipe this risk out just by diversifying, by owning a bunch of different stocks. On the other side, though, you have market risk. This is the big one. It's systematic. It affects everybody, and there's just no hiding from it.
I absolutely love this analogy. Market risk is like that giant asteroid hurtling towards Earth. It doesn't care who you are or what stocks you own, it's gonna affect everybody. Firm-specific risk, on the other hand, is more like a single oil rig exploding out in the ocean. Now that's an absolute catastrophe for that one company, for sure. But if your portfolio is spread out across hundreds of companies, you barely even feel a ripple.
So, this leads to the most important question of all. Why should the market reward you? Why should you get paid extra for taking on a risk that you could have easily just gotten rid of by diversifying? The answer is simple. You shouldn't. The market only compensates you for taking on the one risk you can't escape, that big picture, systematic market risk.
All right, awesome. So now we know.
We only get paid for taking on market risk. But how do we measure it? How can we tell how much of that market risk a specific company, like Apple or Ford, actually has? Well, for that part of our quest, we're going to need a compass. And that compass has a name, beta. All beta does is measure how sensitive a stock is to the movements of the overall market. You can think of it like an amplifier. So, by definition, the market as a whole has a beta of exactly 1. A stock with a beta of 2? Whoa! That stock is like the market on steroids. It tends to be twice as volatile. And a stock with a beta of 0.5? Well, that's a much calmer ride, only half as volatile as the market.
Let's look at some real-world examples to make this stick. You've got industries like recreation and automobiles with high betas, way over 1. And that makes total sense, right? When the economy is humming along, what do people do? They buy new cars, they go on fun vacations, but when things get tight, that's the first spending they cut. On the flip side, look at food products and beer. Their betas are low. Why? Because people need to buy groceries and, well, they tend to buy beer whether times are good or bad. So those industries are much less sensitive to big market swings.
Okay, let's recap. We have our clue, diversification. We have our map, the efficient frontier. We know which risk is the only one that matters, market risk. And we have our compass to measure it, beta. We have finally gathered all the pieces. We've arrived at our destination, where everything comes together in one incredibly elegant and powerful formula.
Now, before I just flash the formula on the screen, let's build the logic behind it step by step. It's actually pretty intuitive. To figure out the fair return for any investment, first, you start with the absolute safest thing you can own, like a government bond. That's your risk-free rate. Second, you add an extra reward just for being brave enough to be in the stock market at all. We call that the market risk premium. And finally, step 3, you dial that extra reward up or down based on that specific stock sensitivity to the market. And how do we measure that? With its beta, of course.
And here it is, the Capital Asset Pricing Model, or CAPM for short. And you guessed it, this is our second Nobel Prize-winning idea of the day. All it says, in math terms, is exactly what we just built. The expected return you should get from any stock is the risk-free rate, plus that stock's beta, multiplied by the extra reward you get for being in the market. That's it. Let's make this totally real. Say we want to figure out the fair return for Loblaw, the grocery store chain. We know grocery stores aren't super risky, and sure enough, we can look up its beta. It's pretty low, about 0.47. So we just plug in the numbers. Let's say the risk-free rate is 3.2% and the market's extra reward is 5%. We take 3.2% plus 0.47 times 5%. Run the math, and boom, 5.55%. That's the fair compensation the market says you should get for the level of risk you take by investing in Loblaw.
So why does any of this matter? This isn't just some dusty academic theory. This simple formula is the bedrock of modern finance. It's used every single day to make huge billion-dollar decisions. It gives companies a tool to decide which major projects are worth funding. And for you, it gives you a benchmark, a yardstick you can use to judge if your own portfolio is actually delivering the return it should be for the risk you're taking.
And that brings us to one final, really provocative question. If this powerful model can tell us the scientifically correct return we should expect for any level of risk, then what does that say about trying to beat the market? Does it mean it's a fool's errand? The model seems to suggest that the only way to get a higher return is simply to take on more market risk, to just find a stock with a higher beta. Something to think about.